Hi, I'm Ankita, and I'm delighted to welcome you to the first ever virtual Emerging Ideas Conference hosted by Edelweiss Wealth Management. We are hoping that discussions thus far have added to our knowledge curve, and by the end of these enriching 3 days, we would intensify our efforts to reinvent as we aim to emerge stronger, bigger, and better on the other side of the pandemic. Our agenda for this very session is to understand investing, but from a multi asset approach while deciphering the hidden signals in the intermarket linkages. The past 4 months have been very eventful for the global markets, with COVID 19 leading us to a steepest plunge, followed by a recovery that was unexpected by the masses amidst the pessimism that prevailed. It was also the time when these intermarket correlations became all the more stark, marked by the increased volatility amidst the asset classes. To understand these and more, we are privileged to host Mr. JC Parets today, who is an expert in identifying the intermarket linkages and is one of the most widely followed technical analysts in the world. He's the founder of All Star Charts, a US based research firm that provides research on US and intermarket stocks, interest rates, commodities, and forex markets. He has also founded All Star Charts India recently, a dedicated platform for investors living and trading in Indian markets. JC's work has been covered by Bloomberg, CNBC, Fox, and a host of other media outlets. And you will often see JC as a speaker at some of the top investing conferences. And he has also been invited to speak at Harvard, Duke, and the likes to talk about technical analysis and behavioral finance. JC specializes in finding the most opportunistic risk versus reward propositions, while at the same time bringing a top-down approach to the market. In 2017, JC launched the Technical Analysis Radio, a podcast dedicated to technical analysis and the technicians who practice it. He splits his time between various cities in the United States, but also does his best to travel the world speaking to investors from different cultures and always trying to become a wiser investor. Without further ado, I will extend my welcome wishes to JC Parets. JC, it is a privilege to host you today, and thank you so much for accepting our invitation. As we start this session, please help us understand what are the intermarket linkages and how can they benefit a trader?
All right. Well, thank you for having me. Should I just share my screen and start getting going? Thank you so much for having me. It's quite an honor to be here. I've visited India several times, and I have many friends there. And I love the food there as well. And when all this is better and all this is over, we can all go back and, we'll have a big event and we'll have a big party and everybody's invited. All right. That's my promise to you. All right. So a little bit about me. I think Ankita, she did a nice job of sort of kind of giving you guys an outline of who we are and what we do. I'm here on the left. My name is JC Parets. Over here on the right, this is Tom Bruni. He's in New York City. And then here in the middle, this is Ayush Munjal. And Ayush lives in New Delhi. And any questions you ever have as far as All-Star Charts research, or even if you just want to say hello, Ayush is always around to chat. He knows our company inside and out. So Ayush Munjal, he's the guy for you for sure. And then just to be clear, nothing we talk about today should be construed as any sort of solicitation. These are not buy or sell recommendations. This is strictly for informational purposes alone. So feel free to go to allstarcharts.com/terms, and it's all laid out there. So this is what we call the top-down approach. We start at the top. We're looking at global markets. Everything we do starts there. And then we work our way down. So we're going to look at all the asset classes. As Ankita said, stocks, commodities, currencies, the fixed income markets and interest rates, and then all of the intermarket relationships between them, which we'll discuss today. Then we're going to look at all of the international markets. If the country has a stock market, we're going to look at it. And it's going to be part of our weight of the evidence approach. Then we dive into the Nifty indexes, the country in which we're focused on, in this case, India. If we were having a presentation in Canada, then we would focus on the TSX. If this was in Europe, we'd look at the Euro Stoxx 600, Euro Stoxx 50, et cetera, et cetera. When we look at the Nifty indexes, then we break it down to the sectors: IT, energy, pharma, fast-moving consumer goods. Those are all of the sectors. Then we look at them both on an absolute and relative basis compared to the rest of the market. And that's when we dive into the specific stocks themselves that present favorable risk versus reward opportunities, where we are trading in the direction of the underlying trend. But for every, let's say, rupee that we are putting at risk, we can make 6, 7, 10 rupees. So let's go over some of our primary tools and techniques. And for those of you who are interested in the slides, you can email info@allstarcharts.com, info@allstarcharts.com, and make sure you give the secret password is mango. I know we're nearing the end of mango season over there. Mangoes are near and dear to my heart. So to make sure you get the right slide deck, because when I was in Mumbai in November and I gave a presentation, the password was Rasmalai. So if you put password Rasmalai, you're going to get that old presentation. So if you want this one, the secret code is mango. info@allstarcharts.com, secret code mango. Okay. So I speak to financial institutions all the time, and two big things they're looking at is relative strength and momentum, right? So let's go over that. For some reason, and I'll do this very quickly. For some reason, when people look at stocks, they ignore completely which direction it's heading in. They're worried about the earnings or who the CEO is or what the news item, and they just completely ignore whether it's going up or down. And this is the most important part of market research, identifying if the rest of the world agrees with you or if you think you're somehow smarter than the market, right? I know I'm not smarter than the market, so I'd rather just be in things that the market already agrees with me on. So when you see a series of higher lows and higher highs, that's an uptrend, right? Very simple. And lower lows, lower highs, downtrend. Keep that in mind. And sometimes you have no trend, and it's just a sideways mess, a hot mess. Europe right now is this, where you're near a flat 200-day moving average. And when you see prices near a flat 200-day moving average, trading those things is a great way to have headaches. If you like headaches, trade stocks near flat 200-day moving averages. All right, so let's talk about momentum. I use a relative strength index. This is different from relative strength. Relative strength is when you're comparing two assets. This is a momentum oscillator, meaning it goes from 0 to 100. And I use a 14-period RSI. And 14-period meaning when I'm looking at a daily chart, that's a 14-day RSI. When I'm looking at a weekly chart, that's a 14-week RSI. And then I want to identify in the same way that we look at the whether price of a stock is going up or down. We also look at whether momentum is in a bullish regime or bearish regime. And traditionally, remember, momentum is an oscillator that goes between 0 and 100. So in a bullish regime, you're going to see momentum getting overbought. It's going to get above 70. Oversold is 30, overbought is 70. So overbought conditions are characteristics of uptrends. They're characteristics of bullish momentum conditions, right? So if people are like, oh, JC, I can't buy the stock because it's overbought. Well, how can an overwhelming amount of buying pressure possibly be a bad thing? I would argue that's a good thing, and we've done the work, and it is a good thing. When you see bullish momentum and overbought conditions, that's just normal for uptrends. So if you think something is in an uptrend and you get oversold, you probably want to reevaluate that thesis. Same thing in a downtrend, right? When stocks are making lower lows, lower highs, momentum is never going to get overbought. But you're going to definitely get oversold. So oversold readings are a classic characteristic of downtrends, right? So oversold readings are not buying opportunities. Oversold readings are confirmation that the stock is in a downtrend. Look at a great example here, Bajaj Auto. This is in 2009, 2010. This is an uptrend in price, obviously, right? I say obviously because it's pretty clear, but notice how momentum is confirming that, never getting oversold. See that? So momentum was also in a bullish regime during this uptrend in the stock. Look at Wockhardt Pharma. This is a downtrend, obviously, right? And then notice how it continued to get oversold and never got overbought, right? Classic characteristics of a bearish momentum regime. Then we also look for divergences. So when prices are making new lows and momentum puts in higher lows, that's what we call a bullish divergence, right? That's a lack of confirmation of a downtrend and actually suggesting that something has changed to the upside. Same thing when prices make higher highs and momentum puts lower highs. Here in this example of ICICI Bank in 2013, with new highs in price, lower highs in momentum, that bearish momentum divergence led to the next decline. We're going to do a lot of ratio analysis when we talk about intermarket analysis, which is what this presentation is about. What we're doing in many cases is comparing two asset classes, or maybe comparing two, in this case, two market capitalization classes. So here we're looking at small caps versus large caps in the United States, right? So as this ratio is falling, that means that small caps are underperforming large caps. The numerator is underperforming the denominator, right? That's what this means. Here's a good example of Nifty Media in 2017 putting in higher lows and higher highs, but relative to the Nifty 500, it was putting in lower lows and lower highs, right? So that was a bearish divergence. That was relative, not relative strength. If there was real relative strength, this ratio would have been up here making new highs. It did not. That's how this preceded the collapse in Nifty Media, right? A substantial collapse. So you could see the relative strength already weakening. There's wisdom in relative strength. Look at the Nifty Metal Index in 2016 with lower lows in the index. We had higher lows relative to the Nifty 500. That was relative strength. That's evidence of accumulation. Those are the big institutions saying, all right, come to Papa. That's what that relative strength means. And then finally, just to touch on Fibonacci quickly, I don't want to get into this huge discussion about it. I don't think that's necessary, but just keep in mind we're looking for the golden ratio. We are looking at 0.618 and we are looking at 1.618. Those are the levels that we're interested in. You have any further questions on that, go to allstarcharts.com/Fibonacci, and I lay all that out there. But just for the purposes of this presentation, these are the ratios that we're interested in, 0.618 and 1.618. And why? Because when markets correct and then exceed those former highs, the market tends to stop or at least pause or at least recognize the 161.8% extension of that entire decline, right? So we're interested in these levels. Same thing on retracements. On a decline, as we retrace that decline, the 61.8% retracement of this decline, the market tends to recognize it. The market tends to pause. So these are important levels that we're watching. And you can see all of the education if you go to allstarcharts.com/education-India, and we lay it all out there. Feel free to peruse at your convenience. All right, so let's get into the FIC. Fixed income, commodities, and currencies. A big theme for us coming into the third quarter, coming into July, a big theme was the US dollar weakness. And remember, this was almost 2 months ago. We're talking about US dollar weakness. So boy, has this worked out in our favor as the US dollar continues to make new lows, right? So this is a downtrend, folks. And, fortunately, we were prepared for this. We've done our best to take advantage of it. You could see it. We're going to discuss some of the implications of a weaker dollar, particularly the strength in emerging markets, industrial stocks, base metals, precious metals too, for that matter. Those trades have worked out very, very well. And a lot of that could probably be stemmed to a weaker dollar. I don't think it's a coincidence, but it makes perfect sense. So with a weak dollar, we expect a higher euro, right? 60% of the dollar is euro. So the dollar index, I should say, is euro. So stronger euro here makes perfect sense. I think euro goes to 125. That's where we're thinking as far as euro USD. We think that continues higher. So as we continue to see dollar weakness, we want to think about what sort of assets will continue to do well in that environment. Swiss franc, one of them for sure. If you look at Swissy and look and compare it to gold, they look exactly the same. So even if you don't care about the Swiss franc, and some people don't, you might care about gold, and a lot of people do. So if you are interested in gold, you really should be watching Swiss franc because they look exactly the same. I don't have the slide with me right now. Just take my word for it. But if I put the gold chart over this, you wouldn't know which one was which, right? We probably would because it's already making new highs. But so what does that say? The fact that gold's already making new highs, Swissy will probably continue to do well. And we're seeing it all over the place. Look at Kiwi over dollars making new highs. Look at Philippine peso making new highs as this makes new lows. Remember, the dollar is the numerator here. So as this makes new lows, that's peso putting in new 52-week highs, new multi-year highs, I should say. So we're seeing a commodity reflation, which makes sense in that weaker dollar environment that commodities are doing well. So here's this is the CCI. So the CRB index is a lot of energy, a lot of oil. So this smooths that out a little bit more, the CCI index. So continuing to make new highs, finding support where it found support in 2008, 2009. So I think that that's interesting as well. So if commodities are going to rally, this would be a perfectly logical place for them to be rallying from. So here's a chart of, and this is where the intermarket analysis comes in. I mean, a lot of this has been intermarket, but what I'm saying is creating new indexes is something that is near and dear to our intermarket heart. In this particular case, what we're doing is we're taking an equally weighted basket of the energy commodities, natural gas, crude oil, heating oil, and gasoline. And these are all priced in US dollars. And what I'd like to point out is the failed breakdown. So the way I learned it, and for those of you taking notes, make sure to write this down because this might be the most important thing you hear me say, is that from failed moves come fast moves in the opposite direction. That comes from my friend Brian Shannon at alphatrends.net. Shout out, Brian. And this is just classic. We broke below the 2016 lows, could not maintain those lows, and are now above it. So to me, that means that the squeeze is on. All right, so here what we're doing is the same thing, except instead of energy like we did here, we are looking at the agricultural commodities here in the United States. We're looking at corn, soybeans, cattle, sugar, cotton, cocoa, coffee, wheat, lean hogs, and orange juice. And then notice how all of this resistance going back 30 years, 40 years, 45 years is now turning into support. So if the agricultural commodities are going to start to do well, this would be a perfectly logical place for that to begin. So here what we did is we did the same thing, but with precious metals, where we're taking an equally weighted basket of these precious metals, in this case, gold, silver, platinum, and palladium. We had just hit our target, these former highs. And for a variety of reasons, we think maybe precious metals take a little bit of a breather. I don't want to be short them. I don't want to be aggressively selling them. I think a breather here is warranted. As they hit our target, we've been very bullish of precious metals. That weaker dollar has certainly helped that trade. Our targets have been met short term. I want to see how they digest these gains, but we have targets substantially higher in precious metals, to be clear. Okay, and we'll get into that. So here what we're doing is we're taking an equally weighted basket of base metals. So copper, aluminum, nickel, tin, zinc, and lead. And then notice how from failed moves come fast moves in the opposite direction, not being able to hold below these lows. So I think the squeeze is on in the base metal complex, not just copper, but the whole base metal complex. So what happens is that by doing this, you're essentially eliminating the copper sort of, you're kind of smoothing it out with the other base metals instead of just looking at copper. But I think copper, if we're above 3, can go all the way to 330, and copper going up means that emerging market stocks are probably doing well. It probably means China's doing well. It probably means US industrial stocks are doing well. It's all a very highly correlated trade with that weaker dollar story. And here's Aussie dollar. What is Aussie? Aussie is a commodity-based economy. When you think Australian dollar, you think, copper and mining and base metals. You think weaker dollar, you think stronger emerging markets, and those are all of the things that we're seeing. Same thing with Aussie yen for that matter, probably a little bit more volatile, probably a little bit more, it probably signifies more risk, risk versus risk aversion. So if Aussie yen is doing well, it's probably because, the stock market's probably doing pretty well in that environment. All right, so the potential inflection point in interest rates, is it upon us? Are we finally here? So let's look at a few intermarket relationships that move with interest rates. Copper gold is one of them. Probably the one that moves the closest is copper gold. Copper more significant of global growth, right? Those base metals, while precious metals and gold is more, conservative. It's more of a hedge, so to speak. Less global growth. So a copper gold ratio is gonna look a lot like interest rates. They trade tick for tick is really what it is. So if this ratio is going to rally, this would be a perfectly logical place for it to rally, as it's been where it's rallied in the past. Another one is regional bank stocks versus real estate stocks. So if the interest rates are going up, the margins and the spreads are better for the regional banks. It tends to higher rates, better for regional banks. However, if the market believes that rates are going lower, you're going to see a relative bid in real estate because the real estate investment trusts pay high dividends. So if the market thinks interest rates are going lower, then fixed income investors are not going to be able to get their yield in the bond market, so they have to go to the stock market to get it. So lower yields, higher bid in REITs. So when you compare regional banks to REITs, the chart looks a lot like interest rates, a lot like copper gold ratio. And if regional banks versus REITs are going to bottom and start to rally at any point, this would be a perfectly logical place for that to happen, because this is where it's happened before over the last half decade. Financials in general should be doing well on a relative basis if interest rates are going up. Again, this would be a perfectly logical place for that to happen. This is exactly where financials started to outperform in 2009 from these levels. So this would be a perfectly logical place for that to happen once again. Okay, so now we're looking at Treasury inflation protected securities. These are the tips, as we say, just a tip. So the Treasury inflation protected securities are comparing to traditional treasuries. These are protected for inflation. So new highs in this is signifying that the bond market is now, for the first time in a long, long time, as you can see by this chart, pricing in some sort of inflationary forces, particularly when you compare the tips to non-inflation protected treasuries, right? And you're seeing a relationship where the tips are outperforming. That's the bond market pricing in inflation. And that would indicate higher interest rates, as well as interest rates ultimately go on to fight inflation also. Here is that chart of the inflation protected securities, treasuries versus the non-protected. And again, if this is going to start to rally on a relative basis, this would be a perfectly logical place for that to happen. See that? And that's exactly what's taking place. So this is signifying that the bond market is pricing in these inflationary forces. And to me, that's further evidence that interest rates are going higher. The US 5-year yield has been a great indicator for a long time as far as what the bond market's going to do and what rates are going to do. But we haven't seen the 5-year sort of cooperate until now. So we're starting to see rates, the 5-year yield start to perk up. We have a bullish momentum divergence, as we mentioned before, what those are. So this makes sense. So now let's see. I think we do get up to 55 basis points, those former lows, and then let's see how the market reacts at those levels. Notice how we're not making new lows. These are all of the developed markets. These are the 10-year yields for Australia and Belgium and Canada, France, Germany, Great Britain, the US, and just notice how we're not making new lows. We're not going up, but we're not going down either. So the fact that we're not going down is like the first time we can say that. So I think that that's relevant. Okay, so here we're looking at the BRICS. So these are Brazil, Russia, India, China, South Korea, and South Africa. And then again, just notice here, look at Russia and India, just not making new lows. I think that's really interesting. And then here, look at the India interest rates more specifically, and just look at the 5-year. I know I keep focusing on the 5-year. I don't think it gets enough attention. If the 5-year is above those April lows, the Indian 5-year yield above the April lows, I think we need to be sellers of bonds. I think that means that interest rates are going to be going higher. That's the level, the April lows in the 5-year. All right, so now let's look at a few trade ideas with all of that. So now think about it. All that means we're looking at doing all that stuff just to put things into context. So now all of the ideas, everything that we're investing in, everything we're buying and selling falls within the framework of everything that we just discussed, right? Okay, so copper. We've wanted to buy this breakout, obviously above 470. Our target is 576. We're about halfway there. Zinc, again, same thing. We're about halfway there. This was a buy above 165 with a target back at those former highs above 230. Again, about halfway there. Gold is achieving our target, as I mentioned, not just priced in rupees, but also priced in the US dollar, achieving that target. I think this would be a perfectly logical area for it to consolidate its gains. I don't think it's a short. I think that it is just deserving of a break. Same thing with silver, right? Back to those former highs. You know, these are all precious metals that we've been wanting to buy for months, and that worked out very well. And you know, you need to know when it's time to go home, you know, and take a nap, and then come back, right? That's now, I think. But when you start to see new highs in gold and silver, which I think we do get later on this year, how soon, I don't know, but I do think we get new highs later this year. I can't tell you how long it's going to take, right? So that's why I think we could be a little patient up here. Natural gas, another big one for us. We've been wanting to buy this for a lot of the same reasons that we discussed. I mean, this would be a perfectly logical place for natural gas to start rallying again, right? Because this is where it rallies every time it gets here for the last 10 years. And sure enough, this time was no different. And that's working out very nicely for us. And I think we go above 200 in natural gas, which is about, and I think ultimately, you know, back up towards 360, which would, you know, it wouldn't surprise me one bit to see that up there at all. All right, look at that big base in rapeseed mustard. Huge base. If we're above 5,100, I think you can own it with a target above 6,100. A lot of upside here. This looks like maybe copper or zinc, or maybe some of the other ones that we were buying, or maybe even, you know, gold and silver before they broke out. That's what this looks like to me. Look at palm oil. You know, I think this is in a range for you. You know, we were talking about Fibonacci, by the way. So you're looking at resistance. You're looking at support. The 161.8% extension of this entire consolidation was these highs. Right? There's a reason why we look at it. So for now, I think this is the ceiling and this is the floor. So until we break out above it, which I think we do, we want to stay away from this. This is something we want to own only if we're above 787. If we're below 787, we do not want to own palm oil, but above that, I like it with a target of 1050. Jira, 14,200. So 14,200 in Jira. If we're above that, I like it long. This reminds me a lot of natural gas before it broke out. I like Jira, 14,200, only if we're above that, with a target of 18,250. You know, rupee looks weak compared to euro. Euro looks like it's breaking out. If we're above 86 in euro rupee, I think you need to be selling rupee, buying euro. Same thing with British pounds. If we're above 97, I think you need to be selling rupee, buying British pounds with a target of 104. And even yen, you know, we keep pushing up against these highs. So if we break out above 71, 71.25, let's call it, you know, we want to be buying yen, selling rupee. So rupee weakness across the board, except in the US dollar. That dollar weakness continues to persist. If we lose these former highs, so that's 74.50, if we break below that, we want to be buying rupee, selling dollars. So here's a closer look at that. We're looking at about 74 and change. If we break below these lows those former highs, I think that confirms the official breakout in rupee relative to dollars. All right, let's talk about what's going on in the world. The trend is up. I don't know if you got the memo, but the stock market is making new highs. In fact, in the United States yesterday, the S&P 500 closed at the highest level ever, like ever in the history of humans. The S&P 500 has never closed higher, and it's not just there. You look around the world, that we're seeing strength, not weakness. The global 100 is making all-time highs. The global 100, all-time highs, folks. Here we're looking at an equally weighted chart of the developed markets. We're looking at the Wilshire 5000 in the US. We're looking at the Euro Stoxx 600 in Europe, and we're looking at Japan. This represents a big chunk of the developed world, most of it anyway. And, former resistance turned into support, right? This is as classic as it gets. And then now we're doing the same thing, but with the BRICS. So this is an equally weighted basket of Brazil, Russia, India, China, South Korea, and South Africa. And former resistance turned into support. This is as classic as it gets, okay? So very normal. Let's talk about some of the tailwinds. The weaker dollar, as we mentioned, is positive for emerging markets and just global equities in general. Look at the equally weighted base metals index. Remember that we looked at copper, aluminum, nickel, tin, zinc, and lead. And then remember how we talked about the failed breakdown led to a fast move. This is the correlation between this basket and emerging markets. Notice all this green. That means that this basket of base metals moves exactly with emerging market stocks, okay? Makes sense with that weaker dollar and everything. And if emerging markets are going to start to outperform, this would be a perfectly logical area for that to begin, because that's exactly where they started outperforming 17 years ago. So if emerging markets are going to start to outperform, and this weaker dollar's got that catalyst, again, this would be a perfectly logical place for that to begin. So here we're looking at the Emerging Markets Index Fund, where 73% of the weighting is China and Hong Kong, and Shanghai and Hong Kong, Taiwan, South Korea, and India represents 8%. We're still below all this overhead supply. So people tell me that we're in a bubble, right? And the stock market is not sustainable. This is what these people tell me. And I'm looking at this chart of some of the most important economies in the world. And we've done nothing for 13 years, and you're telling me that this is a bubble? I would argue the bull market hasn't even gotten going yet, and we're in the infancy stages of a bull market. Shanghai Composite, Chinese investors certainly agree with that statement as we break out. And I'd just like to point out that this looks eerily familiar to this and to this, right? So you've got a downtrend, base, breakout, explosion. Downtrend, base, breakout, explosion. Downtrend, base, breakout. What's next? Explosion. That's how I see it. I think Shanghai could double from here potentially. We've seen it before. So 3,300 is that level. If Shanghai Composite is above 3,300, I think the bet we need to be making is for much higher Chinese stock prices. And then in Hong Kong, this important level near 24,700, we're above it. So from failed moves come fast moves is kind of how I see it. If we're above 24,700, I think Hong Kong is a buy. Look at Taiwan just now breaking out of this 30-year base. People tell me the stock market's in a bubble. What bubble are you talking about? Taiwan hasn't done anything in 3 decades, and you're telling me we're in a bubble? We're just getting going. Just getting going, and just understand what's in Taiwan. A lot of semiconductors, right? So just keep that in mind for sure. Korea, think Samsung, right? I see big bases that are just now breaking out. Look at Nifty. We're going to dive into the Nifty indexes now in just a minute, but if we're above 10,000, path of least resistance is higher towards 13. That has been the target, and that remains the case. All right. So will this rotation fuel the next leg is the big question in the market. And here, this is a post from August the 11th. Why bonds are piquing our interest. Look at financials making new highs, industrials making new highs, energy, big question. These are the laggards in the United States. These are the ones not participating. These are the ones with no tech, no internet, right? There's none of those stocks are in these sectors, and even they are doing well. I think that's evidence of strength in and of itself. Look at U.S. financials and Bank Nifty. You see how they look kind of similar. I certainly do. All right. So small cap outperformance, I think, is the key to all of this working out. Because if you notice, here we're looking at large caps versus small caps in India. So as soon as it started rallying in 2018, that was large caps outperforming small caps. And if you recall, this is when stocks around the world stopped going up, right? So this was a big change in dynamic. So now as we're getting this rotation, notice the beautiful failed breakout. As we get this rotation and this chart now starts to fall, that's the small caps outperforming large caps, which to me, based on what this chart suggests, that's exactly what should be happening if stocks are rallying. This is evidence of risk appetite, not risk aversion. And just wanted to point out more clearly, notice how when this started to rally, stocks stopped going up, right? And then since this has been falling, stocks have been going up, right? So just keep that in mind because we're going to continue to point to that and we're going to look at it now. And then I think it's important to understand what is in these indexes. What's in the Nifty 50? You know, a lot of people, a lot of investors are just unaware, and I'm not just picking on the Nifty 50. In the United States, you know, most people have no idea what's in the S&P 500 or in the Dow Jones Industrial Average in terms of, you know, what weighting, what represents what. So I just want to leave this up for a minute, just so you can really get a good idea, just understand how big financial services and IT are in terms of the Nifty 50. It's half the index is just these two sectors. So keep that in mind and understand how that's different between the smaller cap, right? Like in America, the regional banks are the bank stocks have twice the weighting in the small cap index versus the large cap index, right? So that's a good example. So just keep that in mind, folks. All right, breadth expansion. When we talk about the market, this is a market of stocks and not just a stock market, okay? So we want to see an expansion in stocks making new highs. So here we're looking at the percentage of stocks above their 200-day moving average in the Nifty 500, right? So 200-day moving average, basically a lazy way to say stocks in an uptrend. Because if the stock's above its 200-day moving average, it's probably not in a downtrend, right? I think we can all agree. So the key is we want to be buying stocks when we are above 15% of stocks above their 200-day. That has been the case since over here, and that continues to be the case, and we continue to push higher. So this is a breadth measurement that we only look at in downtrends for buying opportunities. In uptrends, we pretty much ignore it, okay? All right, so then we're looking at breadth thrusts. These breadth thrusts traditionally come at great buying points. Like notice these breadth thrusts in 2016, right? Were great times to be buying stocks, right? You see that? And these breadth thrusts are the percentages of stocks above 70 RSI. So remember we discussed that at the beginning that when RSI gets above 70, those overbought readings are bullish characteristics. We want to see how many companies are showing those bullish characteristics, and those thrusts in that measure tend to happen at the beginning of new uptrends. So just like we've seen that in the past, that's exactly what we're seeing now. And also the percentage of stocks making new highs, right? And a lot of people look at 52-week highs, but the index isn't even making 52-week highs. So why are you looking at how many stocks are making new 52-week highs? If the indexes are making 6-month highs, we want to see how many stocks are making 6-month highs and notice the major thrust in new highs. All right, so let's play the bear case a little bit. Nifty Bank is just is not participating. Definitely one of the weaker areas. Same thing, we're seeing that in the United States as well. Just these do not look like leadership groups, and I think it's important to recognize that. As long as we're below 23,700 and above 20,750, you know, we're kind of in no man's land. It's kind of in, you know, there's really not much to do. They're not going down. They're not really going up either. They're kind of in no man's land. So we will continue to reevaluate and see what's going on. Notice how relative to the Nifty 100, Bank Nifty is just making new lows, multi-year lows down here. So until this starts to catch a bid and we start to see some relative strength, as they say, this is guilty until proven innocent. And then look at Nifty Financial Services relative. Also, just, as long as we're below 1, I don't think there's really anything to do here. For the most part, just ignore it and just watch it. All right, so Nifty 50, we talked about 10,000 with a target back up to those new highs, and then ultimately above 13,000. I still think that that's where we're going. If we're above 10,000, the world is not coming to an end. All the gloom and doomers and the pessimists out there, I don't know what they're looking at. If we're above 10,000 in Nifty 50, there's nothing to be bearish about. Nifty Next 50, that same number is 25,000. I love the Nifty Next 50. When I learned about it years ago, when I first started studying Indian markets, I was jealous that we didn't have one of those in the United States. So I just built my own. I'm like, hey guys, look what I learned in India. They have this thing called Nifty Next 50. So I'm going to create the all-star charts Dow Next 50. I took the next 30 industrial stocks and the next 20 transports and created the all-star charts USA Next 50 because I was jealous of the Nifty Next 50. So target here up close to 32,000, which is those former highs from 2018 and beyond. I think ultimately we get through there. Nifty mid-caps also breaking out above 14,600. I also think we get back to those former highs, about 5,000 points higher. And then same thing with small caps. There's no reason to be bearish if we're above 4,500 in the Nifty small caps. And I think we get back to those former highs. I think that's the major trend here. So let's take a look at some specific sectors. Notice how IT looks so much better than banks. You don't need like intermarket analysis or fancy technical analysis to see that, right? This is very simple. Does this look like the Nifty Bank Index? No. It looks way better, way stronger. So this is the market telling you, where the institutions are focused their attention, and it's in IT and not the banks. They are choosing to avoid the banks in favor of IT. So maybe we should listen. So we've wanted to buy the sector as long as we were above 16,400, which are the 2018 highs, with a target up near 23,300, and we're, on our way. But I still think there's a lot of upside. And notice how we're breaking out on a relative basis as well. So again, not to keep picking on the Nifty banks, but notice how Nifty Bank was making new lows on a relative basis, while Nifty IT is making new highs on a relative basis. Difference? All right. Metals, we're seeing the relative strength all over the place, not just in India, but in the United States as well. This is a global theme, guys. And if we're above 2130, we want to be long Nifty metals and looking for stocks in that area to buy with a target near 34.75. Look at it on a relative basis. Look at that former support in 2015. Once again, last year, we broke down, couldn't hold, and now are above. To quote my friend, the great Brian Shannon, failed moves come fast moves in the opposite direction, and I fully expect Nifty metals to continue to outperform. Look at Nifty Pharma. Nifty Pharma has been, what a winner this thing has been, off those lows. Also a global phenomenon, not just in India. 10,700, that's the level. If we're above that, we want to be long Nifty Pharma with a target of 13,500. Now, on a relative basis, it'll be interesting to see if we're finally able to break out. So our initial target was these former lows, right? And we hit it. And notice how we just haven't done anything since for the last several months. A breakout here, I think, would be really powerful and signal that, yes, in fact, Nifty Pharma is going to go break out to new all-time highs. So we want to look for the relative strength there for sure. Fast-moving consumer goods, again, consistent with what's going on in the rest of the world in this space. Not going down, not a leadership group, pushing up against new highs. Kind of looks like consumer staples in the United States. Not a leader, not a laggard either, but just sort of participating in the rally. On a relative basis, kind of in the middle. Look at the long-term chart. We're pretty much right in the middle of where we've been over the last 10 years. So again, nothing inconsistent with what we're seeing in the price chart itself. Nifty Realty, interesting how we're back above those late 2018 lows. So if we're above 203, I like Nifty Realty with a target up near 300. and then look at it on a relative basis. Support, 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 and now breakdown. But if that is unable to hold, let's call it 0.0185, 0.0190, somewhere around here, with a bullish momentum divergence, I think Nifty Realty could really get going on a relative basis. And I think that would, be the spark, or one of the sparks to get it up towards 300, right? So from failed moves come fast moves comes to mind here as well. Nifty Media has been an absolute disaster, one of the worst places on planet Earth. Just absolute destruction in this sector. And, it's gonna need some work, right? If it was gonna start to rally, this would be a logical place for it to rally, and it has. But this 1540 should be a little bit of trouble. We can even get as high as 2000, right? Which is a nice move. But in terms of leadership, I think it's got some work to do for sure. Nifty Auto, I was just laughing because it doesn't look like US Auto because there's no Tesla in the Nifty Auto. This Nifty Auto looks like what US Auto would look like if it didn't have Tesla. But if we're above 7,000, I like Nifty Auto with a target of 10,400. All right, so now let's look at the individual stocks. So this is that top-down approach. This goes back to June 10th. We were looking at the best opportunities in pharma. We're looking at granules. This is on June the 10th. And this is great for educational purposes because look at this base. This is what we look for. The bigger the base, the higher in space, right? That's how it works. And this base was beautiful. We loved it. We wanted to buy it. And notice how, look at the first target was 220, then 313. Notice how we're hitting these targets. And notice how the market is respecting these Fibonacci levels. Notice how it's stopping at these levels. I'm not making this up. There's a reason why we look at these things. So I encourage you definitely to look at them because the market really respects it. So it's like, okay, you're probably thinking, all right, great, JC. Thanks for taking your victory lap on granules. How's that going to help me now that the stock has doubled in 2 months? Well, like I said, the bigger the base, the higher in space. And I think we can go even higher in space. 460 is our next target. We only want to be long at this point if we're above 312. If we're not above 312, we do not want to be long granules. But if we're above 312, right? So that was our ceiling. Now it's our floor. We only want to be long granules if we're above 312 with a target up near 460. August the 5th, Nifty Metals breakout, right? We're looking at Jindal Stainless Hisar, and we're looking at $60, right? That was pretty much my level, right below $60. Above that, this is on August the 5th, we wanted to buy it with a target near 120. So here we are now. What's it doing? We're about halfway to that target. So here's Jindal Stainless Hisar with a target near 120, which is all of this former support. Okay. So now we're looking at August the 13th. Is the energy sector participation broadening out? So here we're looking at, notice how 2018 we had a major inflection point. This is when Nifty small caps started to underperform, if you recall. This is when stocks around the world stopped going up, if you recall. And notice how the equally weighted Nifty Energy Index started to fall as the cap-weighted Nifty Energy Index continued higher, right? So when this is part of that intermarket approach, where we look at sectors on an absolute basis here in blue, and also on a cap-weighted basis, because we live in a cap-weighted world here in blue, and then here in green, equally weighted, so that every component in the sector has the equal weighting. And notice the major difference between the two. So here we're looking at the equally weighted energy, Nifty Energy, versus the cap-weighted energy. And maybe this is the beginning of a change where we're getting broadening participation in energy stocks, I should say, with lower lows in the ratio, higher lows in momentum. So could this be a turning point? Something we'll be watching. I like NLC here. If we're above 5150, I like this very long. I think this is a double, more than a double. I think it goes to 115, which are those former highs. NLC India, if we are above 5150, I like it long. I also like the bullish momentum divergence. Adani Green Energy has been one of my favorite names for a long time, been a big winner. I like this Fibonacci support here near 336. If we're above that, I like Adani Green Energy with a target of 526. Here's Mindtree. I like this base, right? Look at this multi-year base. If we're above 1060, I like Mindtree long with a target of 1465. Phoenix Mills. Look at the former resistance back in 2007. That turned into support a couple of years ago, turned into support again this year. If we're above 530, I like Phoenix Mills long with a target of 900. Strides Pharma. I love this multi-year base breaking out above 515. If we're above 515, I like Strides Pharma long. Notice the bullish momentum divergence, lower lows, higher lows in momentum, base breakout. If we're above 515, I like Strides Pharma long with a target of 1300. Galaxy Surfactants, I love this big base, multi-year base. The bigger the base, the higher in space. If we're above 1750, I like Galaxy Surfactants long with a target near 2300. Lakshmi Machine Works, 2850, that's the level. Resistance, breakout, support, failed breakdown, 2850, that's the level. We're above 2850, we want to be long Lakshmi Machine Works with a target of 5400. Jindal Stainless, 44 bucks is my level there. Look at the double bottom, slight lower low in price, higher low in momentum, bullish momentum divergence, breakout above 44, target of 125. And I believe this is the last chart. Some people are like, oh my goodness, thank goodness, JC, with all your charts. No, how can I not bring up TCS? Resistance, 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 resistance. Are we finally going to get the breakout? I think yes. That's what you guys were looking for? Did you want a yes here? I have a funny feeling you did. If we are above 2300, we want to be long. To be clear, if we're not above 2300, we do not want to be long, because that is evidence that the market has yet to absorb all of this overhead supply. So let the market prove. Wouldn't you rather pay more knowing that it's already on the way up instead of sitting in this hot mess for years, right? Be patient, wait for the breakout. If we're above 2300, I like TCS long with a target of 2800. So 500 points higher in TCS. If you liked what I had to say and you'd like to get your hands on the slide deck, maybe I talk too fast. Some people tell me I do. Go to info@allstarcharts.com, email them. That's my team, my operations team, info@allstarcharts.com. Secret code MANGO, and we'll get you those slides. All right, how did I do?
Thanks a lot, JC. This has been a very insightful and rather a comprehensive discussion thus far. You have beautifully demonstrated the top-down approach for our audience today. So moving on from the macros to the broader sectors and then pinning it down to the stocks, I think it has been an immense value addition for our investors today, this afternoon. So thanks a lot. The house is open for questions, and you all can send your questions using the Ask a Question button on your screen. And as we collect the question, JC, one thing I gathered from your presentation was the dollar weakness, and dollar, I think today is Dixie is below 93 as we speak today. What do you make of this inherent dollar weakness? Do you think it is likely to sustain, or with US yield advantage getting lost over the G4 countries and second wave or so-called second wave of pandemic in US, there is a chance that a dollar will gain strength in the middle term. So what do you make in the near term and in the absolute short term as far as the dollar index is concerned?
Yeah, I'm not a scientist, so I don't know anything about viruses or second waves or Elliott waves. I don't know anything about any of that stuff. For me, and remember what we're doing, okay? The people with the most amount of money and the most amount of power in the world is hedge funds. They have enough money that they're going to get the best information. Okay, I think we can agree with that. There are also government bodies that have the power that are getting that information. These government bodies may or may not tell you what they learned, right? Maybe they're telling you, maybe they're not. We don't know. But here's what we do know. These institutions, these hedge funds, my clients are some of these, they have so much money to get the right information that we don't know what information they're getting, but we do know that what they've decided to do with that information is to buy stocks. So whatever that information is, I don't know. I don't need to know. All I need to know is that they are deciding that they're going to buy stocks with the information that they're getting. Okay. What else are they doing? They're selling dollars. Why are they selling dollars? I have no idea. Again, I don't care either. One day we're going to find out. A year from now, be like, oh, that's why the dollar was selling off a year ago, right? You know, when the stock market was crashing in February, you know, and now the unemployment data comes out, it's like, oh, that's why the stock market was crashing, right? We always find out later. Yeah. So I'm not interested in worrying about why these things are happening. I'm interested in recognizing the trends, because the reason the technical analysis works is because markets trend. That's just a fact. And what do we do as technical analysts? We're identifying market trends. And right now, what trend is in place? Weaker dollar. Is there a higher likelihood for trends to continue or for trends to just completely reverse course? In my experience, there's a much higher likelihood for trends to continue. So if the dollar's weakening, stocks are confirming that. We're getting rotation into industrials, emerging markets, metals, right? Aussie dollar, that whole story, that whole theme is just confirming that weaker dollar. So is it here to stay? My bet is yes.
Okay. So I think I gathered 2-3 important takeaways from there. One being that institutionals have more information. So their decision is based on the extra information that is there. And I think you're betting on dollar weakness to continue for some time, at least in the near term. So then there's another question that Nifty took multiple supports at 10,000 last year and the year before. So what do you think is the new base for Nifty now?
10,000, that's the level. So, I mean, we're kind of in the middle, right? We're well above 10,000 now. But if we're above 10,000, you know, the world is not going to end if Nifty's above 10,000. I mean, that's just, you know, the world will only end if Nifty is below 10,000. So if we're below 10,000, I can see, you know, maybe being a little bit more cautious or whatever it is. But we're above 10,000. We want to be buying stocks. Choo-choo.
Fair enough, JC. So I think the buying call stays as long as Nifty is above 10,000. There is another question from Mr. Ayush Munjal, and he says that these valuation in pharma stocks like granules, they're very steep. Do you really think they are going even higher? And before I let you answer this a very specific question, I would like to know your views. So basically, for trading in stock markets, there's a view that you should always look at fundamentals along with technicals, because technicals are the ones which define the trend for the market. So help us understand, which camp do you belong? Do you believe in a combination, or you're rather more puristic that you choose one over the other? Over to you.
Yeah, you know, so for me, I know it's the politically correct answer to say that you should use both. I understand it makes people feel nice and, you know, nice and warm and fuzzy, and, you know, makes everyone want to hug each other and one big happy family. But I'm just going to tell you the truth, because I don't need to tell you that. I'm not trying to make everybody feel warm and fuzzy and tell you that technical analysis and fundamental analysis together makes any sense at all. In fact, I think fundamental analysis is a huge waste of time, because you could use that time to do more technical analysis. So, you know, I talk to a lot of people and I'm like, well, if you like the company fundamentally, but you don't like it technically, are you going to buy it? Like, no way. Like, okay. Now, what if you don't like the company fundamentally, but you like it technically? Are you going to buy it? They're like, definitely. And I'm like, then why are you spending all this time doing this fundamental analysis? It doesn't make any sense. So no, I don't think that they should be used combined. In fact, I think the fundamental analysis is nothing but a huge distraction from time that you could be spending doing more technical analysis. So if I wasn't clear enough, I'm a slave to price behavior, Ankita.
Fair point. So we'll flip back to Ayush Munjal's question then. Then the valuations in pharma stocks like granules are very steep. So do you really think they're going higher? Uh,
Ayush Munjal works for All Star Charts, so he's just trying to get me riled up, and he knows that I don't care about any of that stuff. So he's just asking a question so that I can make the point. Thank you, Ayush. So that I can make the point that I'm not interested in valuations at all. I couldn't care less.
Fair point, JC. We'll take more questions. So there's a question from Mr. Vishal Popert, and he's asking that what are the charts indicating about the industries that were most struck by this pandemic? So let's say airlines, travels, hotels, hospitality. What do you make? What are the charts saying about these sectors?
Yeah, they're saying that people aren't buying those sectors. It's just, the airlines, they don't, the airlines, they look like the bank stocks. Those are just not places we want to be. We want to be in IT. We want to be in internet, right? Those are the areas that we want to be. All the whole work from home thing, we're using Zoom today. Zoom has been one of our biggest winners of 2020. I use DocuSign. I feel like every day signing documents. Stocks are going up. I'm not getting on an airplane and going and doing the things that I used to do. And it shows in price, and that's what's really important. They're not buying the airlines. They're not buying the hotels and the casinos. They're buying internet stocks. They're buying software stocks. They're buying, as my friend Howard Lindzen likes to say, rare digital assets. That's the stuff that they're buying. So for me, it doesn't make any sense to buy those laggards. Maybe one day they'll do well. And then when you look at transportation stocks, the airlines are the worst. The truckers are the ones doing well. The railroads are the ones doing well, not the airlines.
Okay. So, JC, we have had a lot of debates recently about, is this a debut of a new bull market, or is it just a retracement in a bear market? Now, what do charts tell us, and what ratios, or how do you look at charts to decipher this trend?
So it's a weight of the evidence thing, right? It's not just one indicator or one chart, but 5,000 charts that we look at on a weekly basis, right? And those 5,000 charts together suggest we're probably closer to the beginning of a new bull market than we are in any bear market. I don't think this is a bear market rally. I don't think this is a counter trend rally. I don't think any of those things. I think the breadth thrust that we've seen, I think the rotation, nifty small caps outperforming large caps. That's the big one, Ankita. That's the big one. If you want like one thing to look at, that's gotta be up there. Another one to look at is the NASDAQ versus US Treasury bonds. So the NASDAQ has been the best index in the whole world. Of all the stock market indexes in the world, NASDAQ's the best, right? Why? Because they don't have any airlines in them. They don't have any banks in them, right? Think about it. It's all the same theme coming back again and again and again, which is part of that weight of the evidence. Like, I didn't even do that on purpose. It's just, I'm talking about the NASDAQ, how great it is. And I was just running my mouth about how bad banks and airlines are. And it's like, well, why is the NASDAQ doing so well? It's because it doesn't have any banks or airlines in it. So it just, again, it makes perfect sense. And the fact that the NASDAQ is breaking out of a multi-year base in relative to US Treasury bonds. I have people telling me that the stock market is in a bubble. Meanwhile, emerging markets haven't done anything in 13 years. The NASDAQ has made no progress in 2.5 years relative to bonds and are just now breaking out. So if the NASDAQ is making new highs relative to bonds, nifty small cap are outperforming large cap, all of those things keep happening, and you're not buying stocks, you're not buying that breakout in TCS, like, I don't know what you're thinking.
Fair point, JC. So we've taken the cues from there. Now, the very big question, specifically for Indian audience, is gold. What is your view on gold? It has made recent record highs. Do you think it's likely to go up? It's the favorite Indian commodity anyway. So tell us what the charts are telling you on it.
Gold's the favorite, not cardamom?
Gold is the favorite. Yeah. Leave aside the spices, of course. Yes.
Yes. We've been very bullish of gold, very bullish. Since February, and it's worked out, faster than we thought. And our targets were literally just hit a couple of weeks ago. So, to tell you that now's the time to be buying would be disingenuous, because we sell things when our targets are hit, which were just hit. Now, that doesn't mean that the overall trend is not up, right? Quite the opposite. I think the trend is still up. So I think it's important to understand what is your time horizon, right? So when you ask me, what do you think of gold? Like, what do you think of gold like this week? What's it going to do tomorrow? What's it going to do in the next year? What's it going to do in the next several years, right? So I think it's important to identify the time horizon. I don't know what's going to do tomorrow, so we can check that one out of the way.
Okay, so I'll interrupt you. Is this time to buy on dip for gold?
I believe so, yes. But I would rather be buying strength than buying weakness. So rather than buying a dip in gold, while I do think that should work, I'd rather buy strength. I'd rather pay more knowing it's going up. How about that for an answer? So this is the stock market, is one of those rare situations where you're better off paying more. In some cases, people are like, oh my God, this JC guy doesn't make any sense at all. Why on earth would you want to pay more for something? The reason is because markets trend. That's why. So if you are trying to buy it cheaper, chances are you're going to be stuck in something, and there's opportunity cost there. In other words, what else could you do with your money? So just to keep it simple, $2,000 in gold, right? And just to keep it in, I'll give you the rupee measures if I could pull up the chart. But just gold's denominated in dollars globally, so we'll just stick with that. We only want to be long gold if we're above those 2011 highs. So if we're not above the 2011 highs in gold priced in dollars, we don't want to be long. I mean, I think it's that simple.
Okay.
And I think it goes to 2,500, 3,000. I think there's a lot of upside.
So that's where you've given the target explicitly, gold nearing 2,500 or 3,000 levels in the near to midterm. Okay, so there's a question that if we look at the ratio charts between commodities and equity, commodities have inched up significantly, at least from the March lows. Now, what are the charts telling you? Is there a commodity reflation bull run that has started, or is that a false alarm that's likely to fade? What are your views, and what are the charts telling you?
Well, remember that every blip for a long time has been a false signal. Just keep in mind how strong that trend of stocks over commodities has been for so long. But that little blip, could this be the start? I think it can be. I do. I think higher interest rates, commodities outperforming, those inflationary bond proxies, Aussie yen, all of those things, gold making new highs, like all of those things together, I think suggest, yeah, we could start to see some outperformance from commodities for like the first time, like in a million years.
Okay, so I think you're bullish on commodities. At least we are hopeful of it, so we stay intact with the hope. Now, there's a question on what's your view on European indices? So French markets, Eurozone stocks, they haven't done anything for decades now. Any signs of up move there?
The problem with European stocks is that they have too many banks. That's the problem. Too many banks, not enough tech. So if you want to own banks and you don't want to own tech, buy Europeans, buy the European indexes. It's quite obvious. In fact, the European indexes, if you look at Italy, you look at Spain, you look at the Euro Stoxx 600, they all look like US financials. They just stuck below overhead supply. I'd rather be buying leaders, Ankita, I'd rather be buying leaders, and Europe is obviously not that.
All right, JC. So I think you're very consistent with your bet on leaders, and I think Europe doesn't turn out to be on
Well,
your list there.
commodities are not leaders. To be clear, commodities have been
Okay,
laggards for a long time. Things I think are changing, but the
but
banks didn't get the memo.
fair enough, fair enough. So I think one of the bigger, and I've been personally been a fan of your tweet that you did, and I think I would like to bring out to the audience when you said if you're shorting goals because you feel equity would be down, then you should rather short equity. So I think one of the bigger understanding from intermarket linkages is also to understand which signal to take and which signal to not take. And I think JC, you've been doing a great job in enlightening us all about it. So there is this question that someone's asked on intermarket linkages is that how do intermarket linkages change now? Now, in the sense that now that QE is happening, and about 45 countries of the 190 countries have interest rates below 1%. So this is the world of large liquidity influx and central banks going extra dovish. So in that scenario, do you see any change in the way we approach traditional intermarket linkages?
No.
So, okay. So you believe all the theories remain as intact as they were in the times before QE and all of it, right?
More so than ever. I think people fail. My simple answer of no, to make the point, is that people think that things change because of QE. These government bodies are market participants as well. You might not agree that they should be doing the things they're doing. You might not like what they're doing, but quite frankly, the market doesn't care what you think or what you like. The fact of the matter is they are market participants too. So I'd argue that the intermarket relationships, the importance of intermarket analysis is as strong as it has ever been before.
Okay, perfect. So I'll pick up the next question quickly. Tell us, how do we use relative strength in India, especially in the 2020 now, and especially after we've seen a rally in the last 4 months of about 50% almost. So where does our relative strength stands now?
Like I've said multiple times, I think the most important area of relative strength for Indian equities is small caps versus large caps. That's it. When you look at when small caps started to underperform, when was that? January of 2018. What happened in January of 2018? Stocks stopped going up. So if there's any area of relative strength that I think Indian investors need to be focused on is in continued outperformance from small caps. That has been very obvious evidence of risk appetite for sure. So as long as that continues, I think stocks in general in India do well. And not to mention, it's been a good proxy globally. So even if you're not even in India and don't even care about Indian stocks and you're in, I don't know, Australia or in, Hong Kong, I would be looking at the nifty small cap versus large cap ratio, even if you don't even care about Indian stocks. That's how important I think it is.
Okay, so the key takeaway is that the risk appetite for the Indian markets is the ratio between the small caps and the large cap. And as long as it's trending up, we could go bullish on stocks. There is this question that what do you make of volatility, especially in light of upcoming events like US elections, trade war, pandemic panic out? What are the charts indicating? Is the VIX ripe for a rebound now?
I haven't seen any evidence that elections have anything to do with the volatility index or, any pandemics or anything like that. The volatility index is a derivative of the at the money calls and puts on the S&P 500, and I think over analyzing the volatility index can get people in trouble. I know myself early in my career, I would get into trouble over analyzing the volatility index. I don't consider it a fear index. For me, I use the VIX in one simple way. I take the VIX, whatever it is, and then I divide by 16. So if the VIX is at 16, let's say, where's the VIX right now? VIX is at, I don't even know where the VIX is, just to show you how little I look at it. Let's see where the VIX is. The VIX is at 21. Okay, so you take 21 and you divide it by 16. It's going to give you 1 point something, and that's what that's the percentage daily move that the market is pricing in. Right? That's it, and that's the extent of my analysis. I know from a business standpoint, the higher the VIX, the higher the clicks, as they say. So, when there's more volatility, there's more people, reading my website and sending me emails. That's my VIX analysis.
I think the idea is not to read too much into the VIX. There's a question, when you make an investment or a trading decision, do you look at benchmark indices and take decisions, or do you think stock trend should be seen as an independent entity of its own for trading decisions?
A great question. And I think the answer is both. So a wise Egyptian man once told me that if you trade the averages, you're going to get average returns, right? And what that sort of reiterates is that we need to be buying stocks and more and trading the averages less. Okay, so with that being said, we're looking for stocks to buy. But all of the decisions we make in the stock market fall within the context of that top-down intermarket approach that we've discussed. So all of that intermarket, analyzing the benchmarks, not just in India, but globally, all of the intermarket relationships that we've discussed, it starts there. And we do that so that we can then decide, okay, should we be spending our time looking for stocks to buy, or should we be spending our time looking for stocks to sell? So if there's a stock that we want to buy, it's probably because we were looking for stocks to buy, right? So that is likely because we're in an environment where the benchmark, to answer your question, likely suggests that we need to be buying stocks. So, it all fits within the same funnel, top-down approach.
Okay, perfect. So we have a lot of questions for you, JC. So I'm going to rush through some of them. How do you see USD INR would move? So rupee has been range bound between 70 and 75 for quite a lot. I think it's been about 5 years. I think it's been in this range, and it has something to do with our own central bank intervening in the external markets as well. But what do you make of USD INR? What are the charts telling us?
Yeah, I as we discussed, 74.50 is that level. So if we're below 74.50 in dollar INR, we need to be buying rupees and selling dollars. So that's the level, 74.50. It's that simple. Those were those former highs in these were the former highs a couple of years ago. So 74.50 in dollar INR. If we're below that, I think we're buying rupees. That makes the most sense.
Okay. I'll take that for an answer. And there's a follow-up question to your question on trends between the indices and specific stocks. So the question is that how does position sizing? So how do you size your positions? How big or small vis-a-vis the index? And could you elaborate that with an example?
You're just position sizing for like a portfolio?
Yes.
Well, everybody's going to have a different answer, right? So position sizing is going to get back to answering 3 questions. So there's 3 questions every investor needs to answer before entering a trade. Number 1, what's my objective? Why am I here? Am I managing a portfolio for my retirement account? Am I a financial advisor? Am I a hedge fund? What are my goals? First of all, just identify what those goals, and then identify what time horizon. Am I trying to make money in the next 5 minutes? Am I trying to make money in the next quarter? In the next year? What is that time horizon? And then stick to it. Because we all know that person who enters a trade and then it goes against them. Now it's an investment, right? Don't be that person. Stick to your time horizon, stay true. And the third thing is understand what your risk tolerance is. how much money are you willing to lose in the off chance that you got this idea wrong, right? So those are the three questions we want to answer. Why are you here? What's your time horizon? And how much are you willing to lose? Okay. So now let's focus on the third one. How much are you willing to lose? Are you willing to lose $1,000, $50,000, $1,000,000, $1? How much are you going to be okay and you're going to be able to sleep at night knowing I lost that? That's okay. I'll get them next time. No big deal. I didn't lose more than that. That's the most I could lose. And I can't lose any more than that. But if I lose that, I'll be okay. Right? Okay. You have to identify what that number is. And that number is going to be different for everybody. But once you identify what that number is, then you want to figure out where you're wrong on the trade. So let's say you buy a stock at 105 and you say in your technical analysis or whatever form of analysis you look at, and you say, okay, if it breaks below 100, I'm wrong, right? That is the market proving JC wrong. So that's 5 points of risk. So you take how much money you're willing to lose, you divide it by those 5 points, and that's how many shares you should own in order to express your thesis within your risk tolerance constraints. How's that?
Perfect. So I think we've taken the key takeaway that, your portfolio sizing is a function of your pre-decided goals, and a person needs to stick to those goals no matter what. You wrong, you exit. Already answers the second question, but I'm still going to ask you if there's something more that you would throw light on, that how do you buy the strength, so you buy the leaders, but how do you decide to exit? When is the trigger point that you go out and you sell and you accept the mistake?
That's a great question. And I think the answer is to identify what your target is before you enter the trade. So before you enter the trade, you want to know where you're going to be wrong. What does the stock have to do to prove you wrong? Right? What's that price? There has to be a price between where you buy it and zero, where you say, hey, I got this one wrong, right? You don't want to wait till it gets to zero to be like, oh, got that one wrong. No, you want to know you're wrong as quickly as possible, right? Instead of finding out 10 years from now that you got it wrong. No, I want to know now. Am I going to get it right or wrong? So anyway, so you figure out where you're wrong, and then you want to figure out where you think it's going to go. And then identify what's the risk versus reward. So let's say in that example where I buy the stock at 105 and I have $5 of risk because in my infinite wisdom, I think that if we break 100, all bets are off, right? Okay, so $5 of risk. And I think in my infinite wisdom, it can go to 150. Okay, so that's a 9-to-1 reward to risk ratio. I like that. Okay, so and that's something else that we need to, every investor needs to figure out. What's that ratio? For me, it's got to be at least 6-to-1. 9-to-1 is even better, but it's got to be at least 6-to-1 for it to make sense. If it was 1-to-1, like let's say I buy the stock at 105 and I'm wrong at 100 and I think it goes to 110, that's a bad trade because for every dollar I'm investing, I can only make $1. That's a bad trade. In the case where I think it goes to 150, right? That's $9 that I can make for every $1 that I'm risking. That's much more attractive, right? So because we're identifying where we're wrong and where we're right, we have to sell when we're wrong and we have to sell when we're right. But when it hits that target, we get out in a very similar way to the gold. It doesn't mean that I don't think gold can go higher. It just means we had a great opportunity. We got involved so that our clients, our targets were hit. See ya. Now it's somebody else's problem.
Perfect. So I think you've reiterated your point here that when you are in markets, you're there to make money. So I think we need to keep our personal self-esteem aside and accept if we've gone wrong and cut losses as much as we can. So JC, somewhere in the presentation, you mentioned that you see a spike in inflation. So are the charts telling you that inflation could come back, given there is also narrative that food inflation is dead forever? So do you expect a commodity-driven inflation to come back? Do you expect all food as well as commodities, both soft and hard commodities, would grow higher? And finally, what is your idea of US 10 years? So it's at 60 bips now, approximately. What do you make of it? What are the charts telling you on the whole inflation and rates front?
As far as, so for me, I care less about the economic implications and more about the price behavior at hand. I'm not going to pretend to be an expert on economics. Quite frankly, I couldn't care less about what's going to happen to the economy. I have no control over it. There's nothing I can do. What I can see is quote unquote inflationary pressures, inflation protected treasury securities breaking out, Aussie dollar, weaker dollar, interest rates finally starting to perk up, the intermarket relationships like copper gold, regional banks versus REITs signifying higher rates. I'm noticing for the first time in a long, gold making new highs. For the first time in a long time, we're seeing these inflationary forces. Is that going to, in terms of the market, is that going to ultimately lead to actual inflation in the foods and the things that you speak of? I have no idea. But in terms of how we're going to act on the market, I guess you could say, yes, that is what we're betting on, I guess. But I'm more concerned with kind of the task at hand. And then, yes, 60 basis points on the US 10-year yield, that's the level. If we're above 60 basis points in US 10s, we were sellers of bonds.
Okay. So JC, I think we've learned quite a few lessons in this conference update that you've given us, and we are very proud of your energy. I think it's about 6 a.m. in California as of now. So the energy is commendable for that hour of the day. And you look at the whole world for price signals. So what keeps you calm and cheerful? What's the trade, that one trick of the trade that our clients can learn from you to replicate the calmness and keeping the emotional biases aside?
If there's anything I've learned, understand your biggest enemy is yourself. Everyone's like, oh, it's the Fed's fault, or it's the Donald Trump's fault, or whatever. Everybody wants to blame everybody except for themselves. But the real hurdle is what you're seeing in the mirror. And it's between what happens between your ears once money is involved. Because when there's money involved, that's when our stress levels are elevated. And that's when we act emotionally and irrationally. And just understand that it's perfectly natural human behavior to act irrationally when your stress levels are elevated. So it's not that you're crazy, it's actually that you're perfectly normal. So understand that you becoming crazy is actually perfectly normal. So there's no way to avoid that. There's no cure. There's no magic pill that's going to help you do that. The only thing we can do is, number one, be aware of that, because that alone just gives you such a huge advantage over everyone else who is either ignorant to the fact that that's how we behave as humans, or in many cases just don't care or refuse to believe that they are Homo sapiens, and have the same emotions as everybody else. Recognize that you have these flaws as a human, and it's perfectly natural. So in order to avoid allowing yourself to make stupid, irrational decisions, we take that ability to make those decisions out of the equation completely. That's why I tell you, before we enter the trade, before we take the crazy pills, we want to decide where we're wrong and where we're right. So that at that point, once you enter the order, there's no decisions to make. You've already made all the decisions. Now you just let the market do what it's going to do. So you've taken your craziness out of the equation completely. So there's no cure. You're not going to get better. You're not going to not be, your stress levels are are one day going to not stop going up when there's money involved. That's just not going to happen. So what's the solution? What's the prescriptive model, if you will? Take yourself out of the equation and predetermine where you're right and wrong. And as my friend Peter Brandt likes to say, JC, he's like he's been doing this for 6 decades. He's been doing this a long time. He says, JC, I am not a trader. I am an order enterer. Because he just enters the orders and let the market decide whether he's right or wrong.
That's I think you've imbibed the spirit of keeping your biases aside. And I think, as you mentioned correctly, the idea is to have predetermined goals and then keep oneself out of the equation to have an objective look at the things that we are at. Okay, JC, who is your inspiration? You give us our secrets. How did you sharpen yourself, and how did you move to starting all-star charts and then choosing to be in CMT? And I know you are a voracious reader. I've run that you've taken inspiration from a lot of books in the early career of yours. So help us understand what are those books and anything that you would suggest our watchers to read and sharpen the skills on the technical front.
Yeah, thank you for that. I think it's a combination of reading as much as you can. I don't think you need to read every book. Some people are crazy readers. I think take your time, take notes, let it sink in, keep reading. You don't need to go read every technical analysis book ever this weekend. Take your time. I think there's no rush, but get through them. So Edwards and McGee, most certainly, is the Bible of technical analysis. It was written in the 1940s. Definitely do it. The patterns and the stuff that they talk about in that book are as relevant today as they've ever been, maybe even more so than when they wrote the book, believe it or not. I'm a big John Murphy disciple. So Technical Analysis of Financial Markets. Highly encourage you to read. It reiterates a lot of the same points that you'll see in the Edwards and McGee book. I encourage you to read all of the Market Wizards books, every single one. Anything that's ever been written by Jack Schwager, read it. And then when you're done, read it again. All of those Market Wizards, they're interviews with the greatest traders of all time, Ed Sequoia, Paul Tudor Jones, etc. So who have I learned from? All of the ones in those books. Edwards and McGee, John Murphy. Brian Shannon is a much more contemporary book, Technical Analysis using multiple time frames. It's a short-term swinging, more of a trade swinging book. My book will be out shortly. I encourage you to check that out. If you go to chartingschool.com, we put together a course where everything I've ever learned is in one course. We're coming out with an India version of that shortly, which we're really excited about. This is actually the first time I think we ever announced that. So big announcement, Charting School India coming to a living room near you. I can't believe I guess we haven't announced it. This is the first time we mention it. So I'm excited about that. And I go over all of these things as well. And then just talking to people. That's really it. You're a young trader, first go buy an old trader a cup of coffee or a beer or dinner, or reach out to them and just be like, hey, I really liked what you wrote about this, or I really liked what you said about that. Like, they'll appreciate it. And they'll take the time. The technical analysis community is one of the most beautiful groups of people you will ever meet in your entire life. All nice people willing to share, what they've learned and have a good time. And I think those of you out there, listening that have met me and, all of our friends and been to different parties in Mumbai or in the States, like, you guys can gather that. And then Ankita, when things get better and, my team and I, we can come back to India. We're going to have a big party. You're invited, so you better be there.
Thanks, JC. That's a long pending party we are all dying to attend now. And I think you've given us a warehouse of knowledge for us to delve in. And by the time I think we meet you next, we would have up our game on the technical front also. So JC, how different are the Indian markets from, let's say, US markets? The size, the depth, all of it differs. So do the signals on charts differ as well?
No, all of the same models that we incorporate in the United States and in Europe and in Japan, we incorporate in Nifty 500 and Nifty 100 in the same ways. The only difference is, the sector weightings are different, right? Financials are the biggest sector weighting in Nifty 50, and then IT. And then in America, technology is the biggest. So the weightings are different. Reliance is half of your energy index. When in our case, it's more like 3 stocks are half the energy index. For us, consumer discretionaries, Amazon is like 30% of that index, when you guys don't have something. So it's kind of just like the dynamics like that are different. That's the case in every country. That's not India specific, obviously. So that's the biggest thing. And then the options market is probably the biggest difference. That's what I would say. All the liquidities in the front month, Bank Nifty, Nifty 50, and that's where the liquidity is, and that's the market, as opposed to in the United States, it's a much more broad-based, there's liquidity all over the place in all sorts of stocks and indexes and stuff like that, ETFs. So the options market is probably the biggest difference, I'd say. But in terms of technical analysis, I can't think of anything that we do in the States that we don't do in India.
So I think the way you look at Indian markets from a technical perspective remains pretty much the same. Jesse, we are nearing the end of this conversation. It's pretty insightful.
I thought we were going to do this all day. We're not doing this the whole day?
Not really, not for now. So there's one last question on what do you make of the whole algo trading things that are emerging and are now gaining momentum also in the Indian markets, and does involvement of machines change the way we look at technicals?
No, not at all. Why would it?
This is an open question from one of our clients. So what do you make of algo trading? Do you think it will pick pace in India in the coming years? And
yeah,
would you rather favor it over the traditional ways of analysis that we are into?
Algorithm trading is just a way to execute trades. It's not really a form of analysis, right? So there are computers fighting each other. That's their problem. That's not my problem. I think what's important to remember is that these computers are built by humans who have the same crazy in between the ears. They turn the machines off at the wrong time. These are still traders. There are humans behind these computers. So I think it's important to understand that. And some people are like, well, I could see the algos taking my trades when I'm entering the trades. Well, one way to beat the algos? Slow down. You're not going to be faster than the algos. So why are you trying? Slow down. And the humans will always be better.
Fair point, JC. I think throughout this chat, what I've learned from you is to just accept what we can beat and where we have to just let go and accept it. So that
pick your battles, Ankita. Pick your battles.
Pick your battles. Yes. So you cannot win them all, but definitely try to win the ones you pick. So I think that is the key message I've been able to garner from this conversation. There's one final question that I'm still going to throw at you before we end this, and that is that crude oil is a very volatile commodity. Is crude going to $100 again?
Yes.
It is. So you remain bullish, or
if oil is above 40, I think you could be long. If it's below 40, stay away. But if it's above 40, going up. 100, when is it going to be at 100? Probably not tomorrow. But can we get there ultimately? Sure, I don't see why not.
I know I said that was the last question, but I'm getting way too many requests on this question. So I promise this is the absolute last. And that is, what is your target on Nifty for next year?
Nifty 50?
Yes.
13,000.
Perfect. So there we have JC Parets concluding with a bullish remark on Nifty. Yes.
20,000. But 13 first. Let's get to 13, and then we'll worry about 20. 13 first.
All right, so I think you've ended this note with a lot of optimism for Indian investors as you pick targets for Nifty at 20,000 levels. Thank you so much, JC. I would love to extend this further, but I would respect your time commitments at this point. It has been a very, very insightful, but also a comprehensive discussion as we've, shifted gears between commodities, rates, equities, stocks, sectors, all of it has been brought under one umbrella by you. Also, thanks a lot for giving us your reading list. And I think most of our investors would like to go through them again. And we hope to see more of you, JC. Thanks a lot for accepting our invitation.
Thank you for having me. I really appreciate it. It means a lot. Anytime you guys need it, you want to talk charts, you want to talk intermarket analysis, give me a call.
Perfect. Thanks a lot, JC. Thanks for coming in.
You want Kita?